Mike Wilson, how can you be as cautious as you've been and not have a massive cash position? What is your cash position? How invested are you within your caution?
Yeah, I mean, we're basically 95% invested. We're like 5% underweight equities. And we've talked about this before. We never go 100% cash.
Yeah, but the financial media does. It makes for great theater.
Of course. Now, what we can do, Tom, is we can be positioned more defensively within our equity exposure, which is what we've done, right? So we're skewed more towards kind of defensive growth, late cycle cyclicals, as opposed to we're not grabbing for beta, we're not grabbing for small caps, we're not grabbing for the stuff that's really kind of vulnerable if things go sideways.
Okay, you're with James Gorman. He's saying, Mike, I don't care about any of this blather. Just tell me about the damn banks. I've been remiss on this. Yeah. Keefe Bruyette Index, you and I know it, we love it. And the answer is, it's a grim chart. You go back to pre-California, pre-idiocy out there with one, you know the game that they went through. It's one of the bearish charts I've seen in years. When do you know to load the boat on banks?
Well, look, it's the same story as the broader market, Tom. The bigger getting bigger. There's concentration, in the winners again. It's like the higher quality banks are performing better.
So are you long Apple?
Well, I mean, we are in many portfolios, obviously, because it's such a big part of the index. But Apple's another category of stock where people are paying up for the quality of the balance sheet, the lack of need for financing. But the banks are representative of the broader market, okay? The higher quality banks are outperforming the lower quality banks. That's just where we are for everything.
Lisa Shallot emails in. She says, ask Mike Wilson with his easy day job. She's got the real job managing money. Do you buy an R-squared tight to the S&P 500, or if I'm active managed, do I want to be idiosyncratic? Who did we talk to in London? Kathy.
That said who? What?
Kathy Wood Ark.
Oh, Kathy Wood.
Kathy Wood Ark. I mean, do I want to buy an R-squared tight to S&P 500, or do I want to get more idiosyncratic?
You want to be more idiosyncratic for sure this whole year, right? I mean, even though the S&P has outperformed, it's been 10 stocks. That's idiosyncratic. I mean, if you pick those 10 stocks, you did really, really well. If you pick the other 493, you didn't do very well. So the dispersion is really, really high, and it makes sense. Right now, the market's paying up for what I would call operational efficiency, cost leaders. It's paying up for good balance sheets. It's paying up for scale. Okay, will that change? Can we broaden out to the lower end of the market? If the market starts to believe that not only do we avoid a recession, but there's a re-acceleration. That's what we need to see. That's what the market's trying to figure out. Hard landing, re-acceleration. This purgatory land is we're just going to kind of slop back and forth, and the market's going to continue to gravitate to the lifeboats.
What does it mean to be defensive? And I keep asking this because some people say it's tech stocks. Some people say it's consumer staples. What do you say?
Well, I think it's both. I mean, obviously the market this year has voted with its feet saying they want to buy large cap growth stocks, not just tech, but growth stocks with good balance sheets that have scale. And I want to point something out that's really important for these 7 or 8 stocks this year. Now, X 1 or 2, most of the earnings recovery for these stocks has been a result of cost cutting, right? They all got over their skis on too much spending last year. They reined that in, and so they've kind of manufactured an earnings recovery. If they don't see top-line reacceleration, this is where we're starting to see a separation now, even in those 7. And I think that's going to be another story for the fourth quarter and next year's. The market wants revenue growth, not just cost-cutting stories.
What we're talking about right now is the bottom line. We're not talking about the rates picture and what that does overall to some sort of macro call on equities. Bank of America strategist came out today and said, do rates matter for stocks? And if so, it's not priced. Do you agree?
Well, for some stocks, it's mattered a ton, right? I mean, I just think, look, we said this at the beginning of the year, this is the most difficult part of the economic cycle. When you are late, we know we're late cycle for one reason, because we got full employment. So you can't argue we're mid-cycle or early cycle, that's silly. What you can argue is that the late cycle period can persist for a lot longer than people expected, and that's what's going on. Rates are the one wild card. The rates have really surprised everybody, bond investors and stock investors. Normally in a late cycle environment, rates come down. Why? Because the Fed's done. As you know, this cycle is unique. That's the tricky part of this cycle, because the Fed can't be proactive in cutting rates ahead of the recession. So we're just going to ride this until basically you run out of gas, and that could be another year. We don't know the answer to that yet.